Quantitative finance is a branch of finance that relies heavily on mathematical and statistical models to analyze financial markets, manage risk, and optimize investment strategies. It merges finance theory with quantitative techniques, and professionals in this field often come from diverse backgrounds, including mathematics, physics, engineering, and computer science. Here are some of the core areas within quantitative finance: financial mathematics, option pricing models. These include models like the Black-Scholes-Merton model for pricing options and other derivatives. They help in determining the fair value of these instruments. Stochastic calculus, used for modeling the random behavior of financial markets and pricing derivatives. Interest rate models, such as the Cox-Ingersoll-Ross CIR model or the Hull-White model for modeling the evolution of interest rates over time. Risk management value at risk, VAR, measures the potential loss in value of a portfolio over a defined period for a given confidence interval. Stress testing simulates extreme market conditions to assess how portfolios might perform under unusual but plausible scenarios. Credit risk models assess the likelihood of a borrower defaulting on their obligations. Portfolio management, mean variance optimization. Developed by Harry Markowitz, this technique optimizes the allocation of assets in a portfolio to achieve the best possible return for a given level of risk. Factor models, such as the Fama-French three-factor model, which explain asset returns through multiple factors beyond just the market return. Algorithmic and high-frequency trading. Algorithmic trading involves creating algorithms to execute trades based on market data, often leveraging statistical arbitrage strategies. High-frequency trading, HFT, uses complex algorithms and high-speed data to trade in fractions of a second, aiming to exploit small price discrepancies. Statistical arbitrage pairs. Trading involves trading two correlated securities to exploit their relative price movements. Cointegration identifies pairs or groups of securities that move together in the long term, useful for arbitrage opportunities. Machine learning and AI predictive modeling uses machine learning techniques to forecast market movements based on historical data. Natural language processing, NLP, analyzes news and social media sentiment to gauge market sentiment and trends. Computational finance, numerical methods. Techniques such as Monte Carlo simulations and finite difference methods used for pricing complex derivatives and risk management. Programming languages such as Python, R, C++, and MATLAB are commonly used to implement financial models and perform data analysis. Quantitative research, empirical analysis. Researching and validating financial models using historical data. Model development, creating new models or refining existing ones based on new insights or market changes. Educational pathways. A career in quantitative finance typically requires strong skills in mathematics, statistics, and programming. Many professionals hold advanced degrees in fields such as quantitative finance, applied mathematics, financial engineering, or computer science. In summary, quantitative finance is a dynamic and rapidly evolving field that integrates sophisticated mathematical techniques with real-world financial challenges.